Well, it's Friday, and it's time for This Week on Review. So push pause, go get yourself a beverage of your choice. No, mine is not wine, it's natural grape juice. And let's review what happened in the market this week. Okay, you're back. Every week we meet together here and review the highlights of the most important news and events that affect real estate and mortgage news nationwide. This week, we had a little bit of wild movements, and we ended the week a little better than where we were a week ago. The big headline is the jobs report was out this morning, and it was much weaker than expected. Let's jump right into it. The news headline shows that the U.S. economy lost 23,000 jobs in July versus roughly 80,000 jobs that were expected to be created. And the revisions for the previous months were also worse. The May jobs report said that there were 129,000 jobs created, but now they revised this number down to 63,000, about half. While June was also revised, originally was 57,000 jobs created, and they lowered it to 20,000. That's about 65% cut. That's more than half. Let's look at the next graph. July's job report surprised to the downside with the economy losing 23,000 jobs, like I mentioned, versus expectation for an 80,000 job gain. That's 103,000 less jobs created than was expected. And when you add May and June's payrolls, which were also revised by the same number, 103,000 jobs, coincidence? I don't know. Who knows? But while these numbers came in lower, somehow the unemployment rate edged down from 4.2% to 4.1%. How does that work? So if the unemployment rate still fell from 4.2 to 4.1, why do we say that it's not necessarily good news? You see, the labor force participation rate dropped to 61.4%, meaning that part of the decline came from people simply leaving the labor force, not from people actually finding a job. So this figure was reduced not because of the strength of the job market, but because people were not being counted anymore because they were not looking for a job. The other issue to look at is that the jobs that were created were mostly part-time jobs, while we lost full-time jobs. That is not good. All this, what it means in layman's terms, is the unemployment rate dropped not because there were less people unemployed, but because there were less people unemployed and looking for a job. You see, if you're unemployed, but you're not actively searching for a job, then this figure doesn't include you. So in my opinion, the numbers are a little skewed and don't necessarily represent the real unemployment. But this has always been the case. So the numbers have always been calculated the same. You see, the Federal Reserve of the United States is responsible for setting monetary policy by adjusting rates to their dual goal of maximum employment and stable prices, which is inflation control. So get the most amount of people employed and keep prices stable. During the last Fed meeting at the end of July, 3 of the members voted to raise the rate and 7 of them voted not to change it. So it remained the same, which is it remained between 3.5 and 3.75 range. When the Fed meeting ended in July, the odds were about 57% chance for a future rate hike before the end of the year. But now after this week's jobs report, the odds have lowered to somewhere between 35 to 44% chances of a rate hike. But like we mentioned earlier, the Fed has 2 goals: maximum unemployment, which means lowest unemployment rate, but also inflation target of no more than 2%. So now that we have the unemployment numbers, but now we have to wait to see where the next week's inflation figures come from, the CPI, which is the Consumer Price Index, and the PPI, which is the Producer's Price Index, and see where those numbers came in at. They're going to come in at. So let's take the gains while we got them this week. Let's be cautious as we look forward to next week. As we review how did mortgage rates react for this week, we can see that yesterday we ended just a little bit higher than we were on Monday. But today we got a little bit of an improvement. This graph doesn't show it yet because they haven't created. So we're ending just a tad better than last week. Hey, we'll take. But as we zoom out and we look at the mortgage rates trend since the beginning of the year, we can see that we are about half a point higher than we were in January. So we were at the low 6%. Now we're in the mid 6%. But what does half a point higher in interest mean for you and for me? Well, it's not that huge difference. So if you're looking to buy a home or refinance, it's still a good time to do so because the difference in dollars and cents, it's not huge. For the average family on a monthly basis, it's actually not a big deal. But let's look at this together. Don't take my word for it. For a $500,000 mortgage loan, the difference in monthly payment between a loan at 6% rate and one at 6.5% rate, it's only about $162 a month. That's not a big deal. Sure, if you extend this throughout the life of the 30-year loan, then the difference in total interest paid, it's about $45,000. That's a huge amount, right? You don't want to overpay $45,000. But the reality is that most families don't keep their loan for 30 years. In fact, the vast majority refinance their loan within the first 10 years for multiple reasons. At some point in the next 10 years, interest rates are going to be bound to be lower than now. Perhaps they need to use some of the equity accumulated in their home, pull cash out to pay off all the debt, for college costs, for home improvements. Or what we're seeing nowadays quite frequently is parents and grandparents using some of the equity in their homes and cashing out in order to do a gift or a very, very low interest loan to their children or grandchildren so now they can buy their home. As you can see here, nearly 0% of the families keep their loan for the whole 30 years without refinancing, while most, which is between 85 and 95%, are going to refinance or sell their home in the next 10 years. So what does this mean, Ben? The moral of the story is right now, it's still a great time to buy a home because you don't have the masses of people competing with you, which are going to drive prices higher. If you can afford the payment now, then I encourage you to jump in and buy. Then when rates come down in the next few years, then we can refinance you to a lower payment. But you already purchased and secured today's home prices. I'm Ben Morales with PRMG Team Experience, and I hope this has been helpful for you. If you have any questions or comments, please drop them down below. Enjoy your weekend.